All right. This is a first for me, guys. So give me a few seconds to just acclimate with trying to figure out the YouTube stream as well as here. And so I can try and make sure I keep up with any comments. I don't actually see, I'm going to have to figure out how I can see comments on the YouTube screen live. I might have to do my phone too. But anyway, welcome to Simplified with Accounting with Cheryl. We have a special guest today, Josh Gonzalez. He is a certified financial planner. I will actually let him do all of his own intro because he's got a lot more going on now than when we were seeing each other on a regular basis. So, but he has an extensive history with New York Life, and I trust that company beyond any other when it comes to life insurance. And I trust Josh with my own financial planning. So I appreciate you for being here today, Josh. Welcome. And thank you for coming out and helping my clients and friends with their future planning.
Great. Yeah, Cheryl, thanks so much for inviting me to your platform. And it's an honor to meet and chat with everyone in attendance today. I have been in the financial planning, insurance, investment industry for over 15 years now. I hold the Certified Financial Planner designation or CFP designation from the CFP board, as well as 2 designations from the American College of Financial Services, Chartered Financial Consultant and Chartered Life Underwriter. In my business life, I focus first and foremost on financial planning. Most of my clients, that means there's a view to retirement, whether that's imminent or something that they want to get in front of and ahead of. But that also encompasses things like different insurance programs, be it life insurance, disability insurance, long-term care insurance. Sometimes we'll incorporate or consider different annuity solutions. A big part of my business is helping with investments, stock and bond portfolios, ETFs, mutual funds, various managed account solutions for clients. But most of what I do is subordinate or done through an overarching financial plan, which is a very comprehensive and exhaustive process that in many ways is an opportunity for people and perhaps their spouses to answer questions that they've been running from about their money for a long time and have to come face to face with it. And a lot of the solutions, investment, and anything else really just comes from finally answering those questions that they have been running from. And I'm sort of that catalyst or person who holds their feet to the fire and makes them, or helps them rather, address those issues. So today, what I have prepared to talk about, but I'm happy to pivot and perhaps touch on something else. But we were going to talk about retirement plans, tax qualified retirement plans for wage earners and self-employed persons. But again, I'm happy to start with a Q&A, or we can talk about that topic first and then pivot to Q&A. I'll leave that to the host and her audience.
So we do have 4 people watching from YouTube, and we have a question already here. So John, how can we help?
Oh, hello. I'm sorry. I didn't mean to do that. I'm just tampering with my screen.
All right. So let's see. We have
if you don't have any questions, Cheryl, I'm happy to start with my first topic.
So we have Mandy in the chat saying, hey, Marilyn, hello from Arkansas. Noriko says, hi, great to see Josh joining you today. And Renee with Mommy Hasn't Showered. She is my Tuesday podcast partner. Narika says, so true. Questions I have been running from. And then
Yeah.
Renee says, can you talk about the easiest plan to get started with?
Okay, that was Renee.
Yes.
Okay. I can't thank Renee enough. We've never met, but you would think I planted her here because that the easiest plan to get started with is probably the most foundational plan. And I'm going to sort of stack these ideas and try to take a building block approach. So the first thing we want to understand is tax qualified, right? What does tax qualified mean? What's an IRA or a 401k? And I'm going to apologize in advance to those people in the audience who are more sophisticated and have a lot more experience in this. I'm going to really go to like pre-K, preschool level, and we'll graduate. I promise we'll be in college level material quickly. So the first thing is the imperative to save. We've got to produce more than we consume, accumulate that over time so that we can live off of that one day. We want to get out of working for a living. That's called retirement. So retirement is really a number rather than an age. I'll say it like this, if I could magically deposit $2 million in your account tomorrow and you could withdraw $8,000 a month for the rest of your life, you probably wouldn't go to work anymore, and that you would be technically retired. So retirement's a number. It is a sum of money. It's not an age that you hit, although we have a government entitlement program called Social Security, which helps people, and there's an age component. But not to be confused, retirement's an age. So we have to produce more than we consume, accumulate that difference over time, and we need it to be sufficient such that we can live off of it for the rest of our life. Well, one thing we can do to help that is we can invest that money for a return. Now, part of the challenge in the tax code is that when you earn interest on interest-bearing savings vehicles, or when you own a stock that pays a dividend, you owe taxes in the current year in which that interest was paid or that dividend was paid out. What's more, when you finally sell out of your investment positions, you'll owe what's called a long-term capital gains tax. So every retirement plan that you've ever heard of, traditional IRA, Roth IRA, pre-tax, post-tax, 401k, TSP, 403b, 457, TO plan, defined benefit pension, et cetera, et cetera, et cetera. None of these are actually investments. They're simply carve-outs in the tax code that give special tax treatment to savings or investments. And the most well-known and rudimentary or simplistic among them is an IRA, or an individual retirement account. And what an IRA allows any taxpayer to do is, depending on his or her age, if the taxpayer in this year will be age 49 or younger, will be to put up to $6,500 away into a tax qualified retirement account, an IRA, an individual retirement account. If the taxpayer is 50 or older, he or she can put an extra $1,000, so $7,500. And
I have a
then
question.
the next wrinkle is if you'd like to take a tax deduction.
What color is
on
your
the
Bugatti? You broke
money
me. Escape
that-
the Matrix.
Sorry, hold on just a second.
That is to say, if you take a tax deduction, which is how all these programs started, you will be able to not pay taxes on the amount that you deferred into the IRA. That amount, all the investment gains will grow tax deferred. And when you're finally at age 59 and a half or older, you'll take withdrawals, and you'll pay on those withdrawals according to the prevailing income tax rates as though they're income. In the late 90s, they innovated two members of Congress. It was named after one of them. So now it's called a Roth IRA. And now you have the ability to make Roth contributions to other kind of retirement accounts. If you forego the tax deduction, that is to say, you pay taxes on money and then put it in an IRA, That money can also grow tax deferred, but when you hit age 59 and a half or older and you take withdrawals, you won't have to pay taxes on the distribution. So you pay taxes on the money once and for all and get out of the tax system forever. So before we start talking about different plans with an employer or for self-employed persons that allow for higher contribution limits, that is the imperative to save. That is the technical definition of retirement. And that is why the government created these codes and these systems, was to facilitate a tax advantage to help workers save and accumulate and invest so that they can actually get out of working for a living. So I'll stop right there and open up for any questions or any points of clarification that anybody might like.
So that's great. One of the things that I teach is that I would rather you pay tax now because taxes are going to cost you more in the future. With everything going on with the economy, how safe are these from, with, you hear about the banks going out of business and things like that. So how safe are these avenues for our retirement planning?
Good question. So the first thing I should do is, again, reiterate that IRA, 401k, TSP, pension, et cetera, these are not actual investments. These are just provisions in the tax code. The underlying investment for most savers is 20 years ago was mutual funds. Now it's more managed stock portfolios and exchange traded funds or ETFs. They all operate on the same principle. And can I share?
Yes.
Cheryl? Okay. So I'm going to put something for the viewing audience to see. And this is a visual representation of investment returns from 1926 to 2016. So this is a period of 91 years. And it compares inflation, treasury bills, treasury bonds, large cap stocks, and small cap stocks. Now, for the interest of simplifying, we'll just say that small companies are riskier investments and there's usually more price volatility, but when they work out, the return is higher. So that is an investment foundational idea, that the amount of risk or volatility that you're willing to take should produce over time a higher return. That is to say, an investor who's willing to endure greater price fluctuation and risk should be rewarded with a higher rate of return over time. And that's what we see. So in this 91-year period, the investor who invested primarily in the most aggressive and most volatile stocks available averaged 11.8% return. That's what this is. Now, what you'll notice is that relative to, let's say, bond investors, which are these two lines here, which are relatively smooth, stock investors had to endure major temporary declines in their stock price, right? This is a period where if you bought in to your stock portfolio or to a portfolio of curated stock positions here at this juncture, it was going to be several years before you made back your initial investment. So you would think that stocks are pretty crummy. But if you would hold for the same period of time, then you're here. Now you think stocks are great. So we can only speak according to historical precedent because no equity investment is guaranteed. They could all lose value. They could all lose value and never get it back. However, in a curated diversified portfolio, when an investor holds his or her position long enough, there's always been a positive return, and it's always well in excess of inflation. And that's the other imperative to save. So remember, I said, what we have to do as people who want to get out of working for a living is we have to produce more than we consume, and we have to accumulate that delta. But the other challenge we have is that the price of everything goes up a little bit every year, and sometimes it's more dramatic than other times. That's the economic phenomena that we call inflation. So it's not enough just to save and accumulate. We actually have to get a return, because if we don't, we lose purchasing power due to the effect of inflation.
All right. Do we have any more questions on this particular route that we're going? Mandy has a question on YouTube, but it is a little different than what you are currently on the path that you're currently on. Vic says, I know about this stuff in regards to the definition. How do you move forward?
Yeah, great question about practical application. So if you know all of this, what then do you do? And the answer to that question has to be derived from your intention. How motivated are you to get out of working for a living? Right? When do you want that to happen? How much would you need to stop working for a living? How much do you have accumulated now? How much are you currently committed to saving and investing on a per paycheck or on a monthly or quarterly or annual basis? And it's in the answer to those questions that we can figure out how many N number of dollars do you have to save with every pay period or every month or every quarter or every year to accumulate the sufficient amount so that you can retire and get out of working for a living. And then what we assume then is we'll catch a certain rate of return between now and then. And depending on your appetite for risk and volatility, we might use a number like 5 to 6%. We might use a number like 7 to 8. We might use a higher number closer to 10. But that part we can only make an assumption. We can only make an assumption. And in a long enough time frame, we suspect that our assumption will be pretty close to what actually happens. So the practical application is figure out how much it would take for you to get out of working for a living now. If we want to project that, if we want to project certain expenses falling off, whether it's kids leaving the house or not having to pay for college or paying off the house, if we want to back out those expenses, that's good because it means our number's lower. We want to figure out how much we have already accumulated now, how much we've already committed on a regular basis to saving and investing, how much that'll be worth when we want to retire, and to the extent there's a shortfall, how do we fund that shortfall? So that's the practical application of saving and investing for retirement. If we have a question in the chat, if you're living paycheck to paycheck, there's really only two things. It's one of two problems, right? So there's either an input problem and you have to increase your income, which again, that's not my area of expertise. Or two, eliminate certain line item costs or debt items that produce a line item cost, which again, is not my area of expertise. Sometimes there are foundational challenges that even preclude you from getting to this conversation, which again, I'm really not professionally competent to advise on how to get over that hump and get to the conversation we're having here.
I can help with that.
Great.
So Mandy in the chat says, I have a disabled child. What's the best way for me to save for his care long term?
Yeah. I had this conversation with a client on Friday of last week, and the challenge that families with special needs loved ones run into is that your locality, your county or your town and your state that you live in has certain grants from the federal government, also has certain allocations from the state's tax-paying base to fund social programs, whether it's adult daycare or job-related programs, whether it's more intensive care for people who can't meet their basic needs for self-care and maintenance. There are programs out there. The challenge for a lot of families is that they're means tested. So it's this weird, it's this challenging scenario where you're too rich to qualify for help from the state, the locality or the state government, but then you're too poor to pay for it yourself. And it's an awful place. And unfortunately, most families that have special need loved ones fall into this gray area, this chasm or this abyss where they make too much money and they have too many assets for the state to help them. And then it's too onerous to pay for themselves. So what you can do is, and this is especially operative once the special need loved one reaches the age of majority, that is to say, once they are over 18, you can put savings and investments and assets into a trust, a special needs trust, that helps that person with living expenses and maintenance and educational expenses, but also doesn't count against them for Medicaid and other locality and state programs. So you're going to want to find a competent attorney who can help you draft the legal documentation. And you're going to want to find a good financial advisor who understands the different tax implications, an accountant or tax professional who understands the different tax implications of holding certain savings and investment vehicles in trust, because there are complications that go into that. But that is a highly specialized part of financial planning and legal practice and a tax advisory, that it's a whole domain unto itself, and there's a lot of complication that goes into it. So that is, I can speak to that generally. Specifics would have to be, we'd have to delve into that offline. Any other questions?
Nothing in the live chat on YouTube right now, and I removed that one person from our Zoom meeting. So I guess at this point we would continue. See, you've got what, another 15 minutes or so?
We're about 15 minutes. So the next thing we can talk about is what wage earners have available to them. So if you work for a corporation or a nonprofit or a state or local government or the federal government, you will have something like a 401k, a 403b, a 457, a TSP. These are what are called defined contribution retirement plans. In these plans, if you're 49 or younger, you can carve out or defer up to $22,500 from your comp and put it into a retirement plan. So this is a huge increase or bump from the meager $6,500 that you can put into an IRA. If you work for an employer with other employees, you can go from $6,500 a year to $22,500 a year. What's more, if you're 50 or older, you can save another $7,500 for a total of $30,000. Okay. So most people who are wage earners, that means at the end of the year, you get a W-2 from your employer and they're withholding your federal and state income taxes and your self-employment FICA and Social Security taxes. you have that available to you. And most plans with most major employers allow for both traditional or pre-tax contributions as well as post-tax or Roth contributions. What's more, many more sophisticated employers will try to entice you to work for them rather than somebody else and offer a match, right? The reason employers offer a match is to try to be more competitive in the hiring landscape. So that's that would be your retirement plan at work. So the other thing is to remember that if you have a retirement plan at work, then you can't use a tax deductible IRA. It's one or the other. And of course, you're going to use the one with the higher limit. But here's something that's really interesting. Depending on your income, you can use your retirement plan at work, but also use a Roth IRA. So remember, the Roth IRA is the one that doesn't give you a tax write-off, but the distributions when you hit retirement are tax-free. There are certain income restrictions. So if you are single, if your tax filing status is single, then to the extent that your modified adjusted gross income, that's your AGI with some add backs, Cheryl, your competent tax advisor, accountant can help you ascertain your modified adjusted gross income. So if you're single or head of household and your modified adjusted gross income is in the tax year 2023 is $138,000 or less, in addition to what you put into your retirement plan at work, you can put up to the $6,500 or $7,500 limit into a Roth IRA. If you're married filing joint, the number is $218,000 of modified adjusted gross income. There's actually a little wiggle room for amounts above, but there is a hard cap and it phases out. So if you make much more than those numbers I alluded to, you either have a dramatically reduced or probably no ability to use a Roth IRA, but it is possible to use your retirement account at work in conjunction with a non-tax deductible or post-tax Roth IRA, provided that your modified adjusted gross income for your tax filing status is under those thresholds. It's totally possible. So the other thing that I will switch gears to and just mention in the interest of time, because there's tons of different permutations and scenarios. What if my husband's self-employed, but I work for a corporation? What if I work for myself and my husband or wife doesn't work? All sorts of things. And there's a million scenarios, and it's kind of self-defeating to go into every single one. So what I'll do is just generally talk about people who are self-employed. And when I say self-employed, regardless of how your company is incorporated, whether that's a limited liability corporation or an S Corp or a sole proprietorship, however you have organized legally, if you're truly self-employed, you can use the IRA that I described at the beginning of this conversation. The other thing, you have several other things available to you, and I'm not touching on what are called defined benefit programs today, which are also known as pensions, which you could use as a self-employed person or your employer might incorporate to some degree. Again, another topic that's incredibly complex, important, but might not be germane to everybody on the call. So to the extent that you are self-employed, you can use a regular IRA, but if you can afford to save and invest more than $6,500 or $7,500 a year, there's something called a self-employed pension IRA or a SEP IRA, which allows you to invest up to 20% of your Schedule C profit, up to some very high limits. I believe the limit is $66,000 this year, but don't quote me. Now, of course, you'd have to be paying taxes on over $330,000 of profit to max out. But again, in your scenario, for the general audience member here, this might allow you to save and invest and write off substantially more than the normal IRA limit The other option is to incorporate or establish a 401k plan of one. So one person can have his or her own 401k plan. Now, these plans are a little bit more expensive to administer, and they're a little bit more complicated for you and your accountant, but you can make substantial, very high contributions while showing relatively low income. So while the SEP IRA might be easier and cheaper to administrate, you might be able to save and invest more while not having to show as much taxable income by using a solo 401k.
That's very, very interesting. That's got my head. I don't know about the rest of y'all, but y'all know how I am about saving money and reducing taxes, and my head's spinning about what we can do with that.
Dawn, I see your question in the chat. It's probably something we'd want to chat about offline. In general, the IRS has thought about, okay, what about all those highly motivated, clever people out there who might want to max out at their job and max out at their side business, and they've thought about that. So there is a high watermark top line threshold that aggregates across all of your plans that you cannot go above. And again, every scenario is different. The number is $66,000. Your employer's match doesn't count against you for that calculation. I don't think, but again, I'll defer to our competent tax advisory professional there. So good problem to have. I'm happy to have that conversation offline and figure out how to squeeze every little bit of value out of that we can. But in general, and hopefully this answers your question, the IRS has thought about this, and there are total limits across all plans, regardless of how many plans you're legally involved in any one year.
All right, so Vic asks, so what do we do? Do we just go to our bank and open a Roth IRA?
Again, all about what you want. You can save your money in a bank and get a fixed rate of return. Historically, you probably will not get a return that matches or beats inflation, which means that over time, even though you're saving money and getting a little bit of interest, you're losing purchasing power. So the nature of our monetary system forces us to chase yield or return and take on price volatility or risk, you can say. So that's something that you have to be cognizant of. The only way you're going to get an 8, 9, 10 plus rate of return on average over the course of your working career, or even in any one year, is if you are an equity investor. That is to say, stocks and mutual funds and exchange traded funds that are comprised primarily or entirely of stocks. There's a lot of, again, risk, and that's why people hire somebody like myself to hold their hand and help them and walk them through that part. Because like I said, you can save in very safe fixed interest savings vehicles, banks, credit unions, et cetera, if you understand inflation and the concept of purchasing power. If you're a long-term saver who's trying to get it working for a living, it's probably not going to happen for you. You're going to need to get the kind of returns that you get in an investment portfolio.
On YouTube, Noriko says, if I maxed out my 401k and IRA Roth at age 63, also in T-bonds, what else should I be investing in?
Yeah, I'm not going to give, I really shouldn't give specific investment advice, but if somebody wants a follow-up consultation after this, I'm happy to chat for 15 to 30 minutes on, I'll pay for my own time. So yeah, in general, it really all depends how much you've already saved up to this point. As somebody who's in their early 60s, we want to go on SSA.gov, the Social Security Administration's website. We want to figure out how much they're entitled to in Social Security at every age between now and 70. We want to do some cash flow analysis. We want to figure out what your expenses, your regular monthly expenses are now. What will they be in 3, 5, 10 years from now? And we really want to figure out, how far off are we from retirement? And then from there, that's going to dictate our investment selection. So I guess, again, I'm not trying to dodge the question. I guess I'm trying to drive home a larger point, which is that investment selection is really downstream or derivative of your overall lifestyle goals, right? So if somebody tells me, hey, I've got $3 million already, yeah, T-bills might be just fine for the rest of your life. If somebody tells me, look, I've got $130,000 and I'm 63 and I'm only going to get $1,400 of Social Security when I'm 67, yeah, we want to develop a plan, and we probably strategically might take on more price volatility / risk to try to chase a higher yield. So again, the point I'm trying to drive home with that is that investment selection is always a result of what you're trying to accomplish.
And then Noriko did say that she will, well, I am assuming, Noriko says that they will email you, and I will put all of Josh's contact information in the description for the YouTube video. And also anybody that's listening can reach out to me, and I will more than happily, pass along Josh's contact info to you.
So investment people are paid. There's a question in the chat: how do investment professionals get paid? There are a lot of different ways. If a financial professional sells some kind of insurance product or hybrid insurance investment product, that person is usually paid a commission from the company. If that person sells mutual funds, which again is not as, it was ubiquitous 20, 30 years ago, it's exceedingly rare now. There's usually an upfront sales charge debited from the investments that the investor makes, that the financial professional is paid from. And there's also some trail or ongoing small fees that they're also paid from. Again, not as prevalent today as it was 20, 30 years ago. What's most common is most financial advisors, people who hold the Series 7 or pass the Series 7 exam, people with certain certifications, people who work for a certain kind of company, they'll have an account minimum, and then they're paid a monthly fee from the account balance. So the way this would work is, let's say Mr. and Mrs. Client give me $1 million to invest, and next month the market cooperates and the account balance is $1.05 million. What will happen then is that amount will be multiplied by some factor, we might call it 0.8%, and then divided by 12. So on that $1,050,000 account, I would be paid $700 this month. So on $1 million, $50,000 account, you would pay me $700 in that, for the next month to manage your money for you, and it would be debited from your account. So it's not billed to you, it's debited from your account balance. So what that does is, for me and my clients, it puts us on the same side of the equation. I prosper when you prosper, I suffer when you suffer. For me to grow my business and my compensation, I have to grow your account balances. So that is, in today's market, how most high-end financial advisors who work for RIAs or wealth advisory or financial planning firms, they usually have passed a Series 7. Many of them, but not all of them, will hold some kind of designation or have special training, and they usually have quite substantial account minimums. So that's how they get paid.
So we have a few minutes left with Josh. He has to be out of here in a couple of minutes. So tell us, I mean, do you have a minimum to work with you? Do you, I mean, who's the
I'll
client that
just,
you take on?
yeah, I will give you a profile of a typical client, somebody who's probably ready to engage with somebody like me. First and foremost, I think it's personality, it's temperament. I think you have to look within yourself, and you're ready to collaborate and work with someone and go through all of these things and figure it out once and for all, because you want the outcome on the other end of that. You want to figure out, when am I going to retire? What's it going to look like? What have I been doing wrong all this time? What should I be doing instead? You have to be in a place sort of emotionally where you're ready to broach the topic and maybe let go of insecurities or fears and really just dive in and really get to the bottom of this thing and figure it out once and for all. So for most people that I meet, the biggest hurdle is temperamental or emotional or psychological. Like I said at the beginning of our conversation, they're running from something. It's a conversation. It's a conversation perhaps within themselves or with their husband or wife or with their kids that they aren't ready to have or they're loath to have. And my job in many ways as a financial planner or a financial advisor is to be the catalyst and to help you through those conversations and through that process. So in many ways, financial planning is a cathartic engagement. That is to say, you're working things out, because a lot of the stuff about investment selection and running financial models and future cash flows, that stuff, quite frankly, and I'm saying this as somebody who's deeply steeped and has been doing it for going on 2 decades and has tons of training in it, that's the easy part. That's the easy part. The hard part is the human element, and it's people really, again, within themselves or within their marriages, is figuring these things out and articulating these unspoken assumptions or expectations of themselves or the other person, or coming to terms with mistakes that you've made in the past, or feelings of embarrassment or inadequacy that you don't have enough money saved relative to your age. But I can tell everybody that the longer you put it off, number one, the more challenging it becomes. And my clients who've gone through it, there's such a sense of relief when they finally do this and figure out this part of their life that they wish they had done it sooner. So to answer your question in a small way, Cheryl, I think the most important thing that somebody the most important characteristic of somebody who's a good candidate for the kind of help that I provide is, again, being temperamentally ready to address this incredibly important part of your life and being ready and open to addressing it in a radically honest way. And then going from there, all the things, like I said, projecting future cash flows and investment selection and insurance programs, those are all a means to an end. We really got to figure out who you are, where you are now, where you want to go, and from there, all of the planning and advice and this program and that program and that really answers itself.
I completely agree. This has been fantastic, Josh. I am going to have to go back and re-listen to the recording so that I can take notes and get all of my thought processes in order. I know that Josh will come back. If anybody wants to reach out to him, let me know. I'll get you his contact information. If you have a specific topic that you would like to talk on further, I know we will come back and talk about children and setting them up for their future.
We have a whole list of topics we can talk about. We can talk about different kind of accounts to save and invest in for the benefit of minor children. We can talk about different insurance programs, life insurance, disability, long-term care insurance. We can talk about different common or lesser known tax deductions for self-employed people. You know, there's no shortage of content. And Kimmery, good to meet you. Thank you. Thanks for having me. Yeah, there's no shortage. So I think a good practice for anybody listening to this would be to think about questions and comments and points of clarification that come up after this, and maybe send them to Cheryl, and then she and I can develop future conversations from that, or just any other nagging questions or looming scenarios that you've thought about as it relates to taxes and saving and investment and retirement and different kinds of insurance out there. They'll get it all out, and over the course of the next several months, I could probably do this once or twice a month. We can talk through it, and then I'm sure there are people out there who probably want to explore a one-on-one private engagement, and again, we'll figure that out and see if that's appropriate offline. Okay.
Fantastic. Josh, thank you again for being here.
Thanks
We
for
look
having me.
forward to the next time, and just thanks again.
Great. Be in touch. Bye-bye. See ya.
Bye-bye. All right, so let me view. Go back to gallery here. All right. So we talked a little bit about budgets and not, maybe living paycheck to paycheck. And those are things that if you are in that situation and whatever age you are at, and you would like to do more for your retirement, for your children, for your future, then, maybe reach out. We can have a conversation and try and get you started along the road to, removing some things maybe that you don't need in your life, minimizing your bills, maybe moving some of those bills into your business and making sure that the business can cover those. And if the business can't cover those, then maybe they need to go away. A lot of times we find that even just not going to Starbucks or Dunkin' or something can be a huge part of our new investment strategy. Renee and I have been talking about the book of The Greatest Man in Babylon. I have not quite finished it yet. It was only 4 or 5 hours. Huh?
Was it called The Richest Man in
Oh,
Babylon?
yes,
Or what was it called?
the richest man in Babylon. Thank you.
I thought that's
Thank
what it
you,
was called. Yeah, I have to read that yet.
So I've been listening to it. I'm almost done. I've got like an hour left, but it's a lot of information to just really absorb. And I just need to finish listening to it so that Renee and I can talk about the final part of it. But like it is talked about in the book, how we budget our money, how we the expenses that we make a priority in our life, those can very easily make or break our future. So if you need help with any of those things, I will look at trying to put together some videos and some resources that may help you with your budget planning. And if you want to have a conversation regarding your budget, your business, my new website is up. So it's sawcheryl.com, SAWCHERYL.com. Come out. There's a couple of free resources on there. There's a checklist for your business. There's a quiz for your business to help you kind of get to see where you are. And you know, if you want to have a consultation with me, we can talk about, you know, what you got going on and what changes you may or may not need to make, then you can do that on there as well. But I really appreciate everyone that has come out today. If anyone has any questions, so I've been following the live chat on YouTube, and Mommy Hasn't Showered says blasphemy about Starbucks, haha. And she corrected me too, Dawn, the richest man in Babylon. Marilyn says, oh, I've read that several times. It's wonderful. Max joined us, says, I've been going deep into my financials lately, especially budget versus actual. Fantastic. Glad that you were able to join us too, Max. So thank you guys all for being here. I'm happy to stick around and answer some questions on whether it was something to talk about that we talked about with Josh, or whether it is our weekly bookkeeping, accounting, tax stuff. Let me know, and let me know how you guys like this particular format. Do you like the Zoom that's done live, and you know, do you want me to continue to do it that way? So I'm really curious of what you guys think about that. Oh, Vic says yes. All right. Kimberly says, minus the trolls, it was great. Yeah, that was a first for me. I've never had to deal with that before, but I figured it out. I reported them, and that seemed to be able to keep them out of coming back in. I mean, the one person kept changing their name, and I can't tell who it is until they start being trolly. Is that a word, trolly? Let's see. Narika says this format was great. Max says my favorite kind. And good job on blocking that kid. Thank you. I appreciate it. This was definitely a first, and it wasn't easy. I was having to follow the YouTube on my phone, plus keep up in here. So I did not get the information that Josh was talking about. I'm gonna have to go back and re-listen to this stuff. I feel like I was very ill prepared, but he did a phenomenal job, and I can't wait to have him back and get some more information from him. So that being said, I'm still doing a lot of talking here. Does anybody have any questions? Vic says, I feel ill prepared for life. Yes, on a daily basis when I wake up in the morning. I feel slightly better after I've had my coffee, and a little bit better than that after I've had my ADHD medication. So, well, thank you, Noriko. I hope I pronounced your name correctly. All right. All right, so Vic, I'm pretty positive that none of us that are listening, unless it's tech, has $1 million to invest. But that's okay. We don't need to have $1 million to invest. What we need to figure out is the principles behind what Josh was saying, and then figure out what we can do to best prepare for our future. There's a lot of us that I talk to on a regular basis are on the older side, younger than me. Most of you guys are younger than I am, but not the super young, right? Not the super young kids that that where we wish we were when we had this knowledge, you know, that we could have had this knowledge 30 years ago and be rich and retired by now. Because if I had known about eBay and things like that back when I was just starting to have kids, I would be in a much different situation now. But I'm in the same boat with most of you, did not. And like my retirement is right around the corner. I'm 53. And while I don't ever feel like I need to retire because of what I do, I enjoy what I do. That doesn't mean that I don't want to have a comfort income level that I'm not having to struggle with or worry about on a weekly or monthly basis. You know, so I want to have that nest egg that I can fall back on and, you know, take time off with and stuff as well. And I want to move out of this country. So there's that too. All right. Let's see. Oh, yay. Max says, and water. What is he getting on with Michelle? Is he trying to force water on me with Michelle? I mean, actually, look, I'm drinking water today. Kimmery and Dawn both have Pepsi. Kimmery was during the whole call with the Pepsi can. Side gig. Hi, side gig. I am so glad to see you today. Renee said that you had found us yesterday and we couldn't see anybody that was in the chat. So thank you for reaching out to Renee and letting her know. I really do appreciate it. Max says, that's a great book, by the way. Principles. The Principles is a good book. Max, you're going to have to tell me about that. Marika says, where do you want to live? Someplace like Costa Rica, Belize, somewhere nice, balmy, comfortable. I can wear sleeveless shirts all the time. Have a pool that looks out over the beach and the water because I don't want to get in the water. Mommy hasn't showered. Renee says water because of this diet. Oh, and if you have not seen what she's doing, you guys got to go over to Mommy Hasn't Showered. She's doing the cabbage diet. Like, I love cabbage, but my husband and my dogs would throw me out of the house. I actually did my first remix this morning on hers. So you guys gotta let me know how that went. Renee says, hi, Kim. Marilyn says, I've discovered that when people retire, their health goes down, then they die. I'm going to work until I drop. Right. You know what? I don't think it's necessarily that we have to work, but we can't quit learning and we need to be active and we need to do things, you know, travel, enjoy life, go have some drinks, you know, play games, visit with people, visit. I'm like, people, wait, what did I just say? Actually, I really do enjoy hanging around with people when it's the people that I like to hang around with. So, you know, like the friends that I've made in the different reseller group, there's only one. And online and here and the guys and the gals that I talk to on a regular basis, you guys, I like hanging out with you guys. And I know that we don't get to hang out in person a lot of times, but this kind of feels like it's in person a lot of times, right? Let's see. Max says top 10. Okay, so I'm guessing the name of the book is Principles and it's in his top 10. or Costa Rica. I'm not sure which. That's what happens when you're getting a delayed response from the YouTube side of things. And let's see, Noriko says, love those places, way more affordable than Hawaii too. Absolutely. I watch the newer, which is offline now, but I watched the newer version of Hawaii Five-0 and what is it? The NCIS Hawaii. I love looking at, you know, they pan in over the ocean and stuff like that. It's just gorgeous. And I'm not a beach girl. I love looking at the water. I love watching the sun go up and the sun go down, but I'm not a sand kind of person. Oh, Renee says, add that to the book list. Okay, principles. And Max said so. So I will make sure that I get with him and make sure I get the right book. Oh, and he said both. So Costa Rica and the book. Noriko's got to go. Thank you for being here, Noriko. And all right, so I got that to the book list. All right, well, Dawn says, I just want to be somewhere warm in winter. Absolutely. I completely agree with you. I don't want another winter day unless I choose to go somewhere that's cold for a limited time and then I can leave. Dawn says carbonated water is the first ingredient in Pepsi. And I watched her look. So now I know why she was looking at the bottle. I'm preferential to Coke, not Pepsi. But that's okay. You add rum or vodka to it, it's all good. All right, well, thank you guys for being here today. I really do appreciate you. It is 1:03, so if you are in the reseller group, it is time for Michelle's call has already started. I will see you guys over there. Thank you again for being here. And I appreciate you. I can't thank you enough. Have a great day.